The 10-year yield's down more than 20% year to date. 30-year yield record low. Is this a sign that a tipping point for stocks is, in fact, closer?
I don't think so. Look, there are so many other things affecting the bond market. We've been big proponents of the liquidity push from central banks into the bond market, the reallocation that global investors have made towards U.S. assets, and particularly to the bonds. I don't think we should take too much signal from yields today and say, you know, at this point we're at an inflection and that equity markets are going to have to sell off as a result. Everyone is looking for an excuse. There's a lot of uncertainty, a lot of anxiety around the move that we've had thus far year to date in equities.
Isn't it justified? I mean, isn't it justified, this anxiety that we're feeling now? I mean, I don't know how. I mean, what do we have? Like 3 dozen companies that have come out in minimum and said earnings are going to be affected by the coronavirus?
It's a temporary thing, though, and a lot of the market is looking through that. It's a question of when the earnings are going to hit and which quarter they're going to hit, not whether or not we're going to see a massive and sustained demand destruction. I don't think any of us believe that's the case. I think the one thing, if I were to be honest, that gets me a little bit itchy is positioning and sentiment right now. I've paid a lot of attention over the years to flows, and the inflows into global equities year to date have been pretty phenomenal, recovering over a third of the redemptions in 2019. And it's even more stark when you look at things like EM in China, where everyone is looking through the noise. So I will say I'm staying long, but I am thoughtful around sentiment and positioning.
So, Josh, it was a couple weeks ago, Mohamed El-Erian said, don't buy the dip. OK, he's been saying every time he's been on that, look, this virus thing is serious. You guys better take it as such. And today he says the notion of this being transitory, as Kate Moore suggested it may be, and quickly reversible is far from certain. That's fair, right?
Sure. But that's why stocks are risk assets. And when you own them, you get better returns than you would in cash because you're assuming that risk. And I actually don't think you're being paid for that risk with the current market multiple. We're a very expensive market relative to history. Absolutely. Relative to the rest of the world. We're really not getting paid for the risk of this disease becoming something that gets more out of hand. I agree with what Mohamed is saying. The thing is, though, there have been a lot of risks over the years that we really haven't been getting paid for in the form of a cheaper valuation, and they've been brushed off. So I think what's happening here is a couple things. I do think people are concerned about this, and you may not see it in the S&P 500, but you certainly see it in gold up 4.5% this week. I want to put up this chart of long-term bonds. So this is the Treasury yield. I asked them to go as far back as they could. We are at a level in the 30-year Treasury. You know when the last time we've been trading at this level?
Never. And the yield, never. And it's a record low.
Never.
Yep.
So people are concerned. All of that is being reflected in assets away from the S&P. But then the other thing that's going on here is this Pavlovian conditioning where people have learned after the 12th, 13th, 14th time, every time I sell stocks for name your reason, I look like a moron a month later. People have learned. So I think there's some element of that. And of course,
I don't disagree with you.
Of course, that's not healthy. Like there should be maybe a little bit more fear reflected in the market. So I'm not rooting for new highs every day. I'm not rooting for us to brush this off. I'd be perfectly fine if we go back to flat on year. I hope it's not because more people get sick. I'd be fine with it if it happened for no reason at all. I do think there is some complacency in the S&P.
You feel, Dubravko, like we're at a tipping point? I mean, how can you have a 10-year yield at 145? Josh just said, we mentioned at the top, a 30-year record low. Gold's up. The dollar's been rising. U.S. market PMI today shows contraction for the first time in a number of years. What's the message in that? That cannot be, oh, everything's just fine and dandy, and it's only happening because rates around the world are low.
Mm-hmm. No, I don't think everything is fine and dandy, but I think, first of all, we should take a step back. Where were we 2 months ago before coronavirus broke out? We were in a situation of what I would call some form of early innings of a global business cycle recovery. You were definitely seeing it in Asia, you were seeing stabilization in Europe, and you were definitely seeing some form of reacceleration in the U.S. So obviously you get this temporary shock, and again, I'm using the word temporary maybe here a little bit loosely. That's sort of distorting things a bit now. So, yeah, there is definitely some cause of concern. Headline risk is still somewhat elevated. Companies likely continue to guide down. We saw the PMI numbers today. We will likely see some more weakness. But I think the bigger question is this cycle still intact? Does this cycle now get derailed because of what's happened in the last month or two, or do things simply just get pushed out, delayed, and we actually end up seeing a relatively healthy second half of this year? And I would argue more for the latter than the former. And that's why I think the equity market remains supported. Now, in the short term, yes, you could see some weakness, but I think broadly speaking, this is still an up market.